Do you know that in less than 2 years, if you miss out on these 7 types of assets, Do you know that in less than 2 years, if you miss out on these 7 types of assets, it will take you 5 to 10 years to catch up to others? This is not a scare tactic. This is the reality of economic cycles, and is a pivotal milestone. Look at what's happening. Inflation is still smoldering in many places. Gold prices have been volatile and have broken all-time highs several times. The real estate market is restructuring, but opportunities are opening up for those with foresight. Technology and consumer trends change daily. We are entering a phase like a narrow gate. Those who prepare the right assets at the right time will pass through to a wealthier world. Those who don't will be stuck for another decade. There's one thing the rich often do better than the rest. They don't let their money sit still. While most of us keep money in savings accounts and wait for bank interest, the wealthy have already allocated it to income-generating assets, defensive assets, and cyclical assets. If you are still hesitating, you need to remember that time waits for no one. The hourglass is running, and every day you procrastinate, you lose the opportunity to accumulate wealth. In this video, I will share with you 7 types of assets that anyone can start with, even with a small capital. You don't have to be a millionaire. You can start with $500, $1,000, or $5,000. The issue is not how much you have but how you allocate it. Imagine if you had a sound portfolio of assets before, you would enter the new decade with a significant advantage. While many are struggling, you will already have a steady cash flow, defensive assets, and the opportunity to break through. To make sure you don't miss the next parts of this series, subscribe to the channel Get Rich Academy and turn on notifications. Because every Sunday at 8 p.m., I will release the next video, which will analyze each asset and each strategy in depth. If you found today's video helpful, leave a comment. I am ready. Because who knows, that comment could be your first commitment to your financial change. Among the 7 assets I will share, there is one type of asset that 99% of people overlook. Many don't even consider it an asset, but that's what keeps them poor. The rich, on the other hand, see it as the foundation of wealth. Can you guess what it is? I will reveal it at the end of the video, and it's number 1 on this list, so watch until the end so you don't miss out. And now, let's start with the first asset I want you to hold. I've placed it at number 7. This is what helps you stay safe through any fluctuation, like a shield protecting you from any financial shock. If you lack this, you could lose everything else. Guess what it is? That's right, it's a money market fund and high liquidity channel. And I will analyze it right now. Money market funds and high liquidity channels are the first foundation in any financial plan. Many people often ignore it because they think that holding money doesn't generate much profit. But because they ignore it, when fluctuations occur, epidemics, unemployment, crises, they don't have a safety net to protect themselves. Remember, to build a tall building, you need a strong foundation. And on the journey to accumulating wealth, money market funds and high liquidity channels are that foundation. So, what is a money market fund? It's simply a channel that helps you store money safely and flexibly, which you can withdraw at any time while still earning a higher interest rate than leaving it in a checking account. In Vietnam, many brokerage firms, banks, or investment apps now offer money market fund products. The strengths of money market funds are high liquidity. You can withdraw your money in just one business day, sometimes just a few hours. The interest rate is stable, often higher than non-term savings and sometimes equal to short-term savings. Low risk. The fund primarily invests in short-term bonds, certificates of deposit, and other safe debt instruments. For example, instead of leaving $5,000 in a checking account with almost no interest, you transfer it to a money market fund. Each year, you can receive 5 to 7% interest. It sounds small, but it's much better than letting your money sit dead in the bank. And more importantly, you have the flexibility to pull the money out and invest immediately when an opportunity arises. This is what the rich always do. They don't let money sit idle in their wallets. They always have a portion of their money in a ready state, which is why they can make quick decisions when opportunities come. Another point you need to remember: money market funds are not for getting rich, but for keeping you safe and flexible. It is a staging area for cash flow, a place where you temporarily store money while waiting to make a decision. Here's a real-life example. During the COVID-19 pandemic, many people lost their jobs, and many companies shut down. Those who had a 6-month emergency fund, typically kept in a money market fund or a similar channel, were able to calmly get through it. On the contrary, those who didn't had to sell off other assets or borrow at high interest rates. So, how much should you keep in a money market fund? The rule of thumb is 3 to 6 months worth of living expenses if you are young and have a stable income, and 6 to 12 months worth of living expenses if you have a family, young children, or an uncertain job. Also, for those who run businesses, you should also have some money in this fund to ensure cash flow when you need to turn things around. When you start, you don't need a lot. Just set aside 10 to 20% of your income regularly each month and put it into a money market fund. After 1 or 2 years, you will be surprised to see that you have enough to protect yourself from any situation. As you can see, this asset may sound simple, but it is extremely important. It is the shield that allows you to confidently move on to other assets. If you ignore it, all your future plans could collapse with just one unexpected shock. And now that you have a safe foundation, let's move on to asset number 6. This asset is both safe and helps you benefit from interest rates while also being able to stagger maturities to reduce risk. Can you guess what it is? That's right, it is government bonds and reputable corporate bonds. Government bonds and reputable corporate bonds are asset number 6. This is an asset that is both safe and provides more stable returns than a money market fund while also helping you maintain discipline in allocating capital. When people mention bonds, many will find it dry or recall the risky bond scandals from a few years ago. But you need to understand clearly that not all bonds are the same. There are extremely safe bonds, which are even considered the gold standard for not defaulting. These are government bonds. Why should you have bonds during the T period? Stability. Bond yields may not be as high as stocks or real estate, but they are almost more certain. Safety. Government bonds are guaranteed by the state. This is an asset that large funds, central banks, and even billionaires hold. Diversification of risk. When the stock or real estate market is highly volatile, bonds often hold their value, which helps to balance the portfolio. How to choose safe bonds. For people with small capital, prioritize government bonds or top-tier corporate bonds, large, transparent, and publicly listed companies. Stay away from unusually high-interest bonds, 12 to 15%, issued by lesser-known companies. High interest always comes with high risk. Check the credit rating or reputation of the company. Laddering strategy. One of the smartest ways to hold bonds is with a laddering strategy. You divide your money into many small parts and buy bonds with different maturities, 6 months, 12 months, and 24 months. When a short-term bond matures, you can reinvest in a new maturity or withdraw it for use. This way, you get a better interest rate than short-term savings and have the flexibility of not having your money locked up for too long. A real-life example. Suppose you have $20,000. Use $5,000 to buy a 6-month bond, $5,000 for a 12-month bond, and $10,000 for a 24-month bond. After 6 months, you have a matured amount to rotate. After 1 year, another amount, and after 2 years, the largest amount returns to you. This way, you have steady interest and flexibility. Compared to savings, if you withdraw from a savings account before maturity, the interest rate drops to almost zero. With bonds, you can resell them on the secondary market and still have the potential to earn a profit or at least recover your capital at a reasonable price. Common mistakes when investing in bonds. Chasing high interest rates. Seeing offers of 12 to 15% and jumping in. Not checking the issuing company, just listening to the broker. Putting all your capital into one type of bond instead of splitting it by maturity and company. The wealthy always hold a portion of bonds in their portfolios because they understand that accumulating wealth is a marathon, not a sprint. Government bonds and reputable bonds are the flat road that helps you maintain a safe pace and not run out of breath. You can start with just $1,000 to $2,000 through reputable investment apps. You don't need a large amount of capital. Most importantly, you form the habit of regular allocation. So now you have 2 layers of protection. The first layer is a money market fund with extremely fast liquidity and flexibility. The second layer is safe, stable, and disciplined bonds. And right after this, we will move on to asset number 5. An asset that is not only safe but also helps you benefit directly from the growth of the economy. This is how you can go along with the development of the market instead of standing on the sidelines and watching others get rich. Have you guessed what it is yet? It is index ETFs, a simple, effective, and increasingly popular investment tool worldwide. Index ETFs, exchange-traded funds, are asset number 5 that you need to own before. This is a tool that is safer than individual stocks and helps you benefit from the overall growth of the economy. People often call ETFs the way of investing for the lazy but smart. What is an ETF? An ETF is an investment fund that tracks a basket of stocks. For example, the VN30 ETF tracks the 30 largest companies in the Vietnamese stock market. The Diamond ETF focuses on leading companies with limited foreign ownership. The FinLead ETF focuses on the banking and financial group. When you buy an ETF certificate, you are buying a small part of this entire basket of stocks. You don't have to rack your brain choosing each individual stock. Why are ETFs suitable for the period? 1. They are simple. You don't need deep analytical knowledge, you just need to choose a reputable fund. 2. They reduce risk. Instead of putting your money into 1 or 2 stocks, you hold a basket of 20 to 30 stocks. 3. They have low costs. The management fees for ETFs are usually very low. 4. They have high liquidity. You can buy and sell ETFs on the stock exchange just like regular stocks. 5. They benefit from economic growth. If the Vietnamese economy continues to grow, market indices will increase, and ETFs will follow. DCA strategy with ETFs. The smartest way to invest in ETFs is not to go all in at once but to use DCA, buy regularly at a fixed interval. For example, you set aside $500 each month to buy the VN30 ETF. When the market is high, you buy fewer units. When the market is low, you buy more units. After 3 to 5 years, your average price will be reasonable, and you will be almost guaranteed a profit if the economy continues to grow. A real-life example. If you used DCA on the VN30 ETF from until now, despite the crashes you would still have a double-digit annual return. Many studies show that 90% of individual investors underperform the market when they choose individual stocks. But if they just bought an index-tracking ETF, they would have won against the majority. How to start with a small amount of capital. You only need a brokerage account and a few $100,000 VND to buy an ETF. Some apps now even allow you to buy in small amounts rather than a whole lot. The important thing is to choose a stable ETF and stick with it for the long term. Don't jump around too much. Common mistakes when investing in ETFs. Thinking that ETFs are for getting rich quickly, buying once and hoping for an immediate increase. Buying and selling frequently in the short term, losing money on fees and missing the opportunity to DCA. Not being patient. ETFs need at least 3 to 5 years to show their power. The wealthy and large funds worldwide always have a portion of their portfolio in ETFs. Warren Buffett once said, "If you don't know what to invest in, buy an index fund and hold it for the long term." So, by now, you have 3 solid layers of assets. 1. A money market fund for safety and readiness. 2. Bonds for stability and discipline. 3. An ETF to grow with the economy. But your portfolio will not be complete without a classic defensive asset that has existed for thousands of years and has never lost its value. That is asset number 4, gold, a symbol of preserving value and a shield against inflation. Gold is asset number 4, an asset that has existed for thousands of years, has gone through countless crises, and has still retained its value. People call gold the real money, the last line of defense against inflation and economic instability. Think back to history. Whenever there was war, crisis, or currency collapse, gold was always a safe haven. In Vietnam, many families survived hardships just by holding a few taels of gold at home. That's the clearest evidence. Gold is not just a metal, it's a financial belief that has existed for generations. Why should you hold gold during the period? Smoldering inflation. When money loses value, gold often increases. Economic and geopolitical instability. Every time the market shakes, gold becomes the destination. It is a global asset. Gold is recognized in every country and is not dependent on any government. In the context of being predicted as a pivotal milestone in the economic cycle, having a portion of gold in your portfolio is like installing an airbag for your financial vehicle. How much gold is a reasonable amount to hold? The general rule is that 10 to 15% of your total assets should be in gold. Don't go all in on gold because gold preserves value. It doesn't help you get rich quickly. Gold is a balancing tool, not a weapon for getting rich. For example, if you have $20,000, keep $2,000 to $3,000 in the form of gold, and allocate the rest to ETFs, bonds, and money market funds. Smart ways to buy gold. 1. Buy in small increments. Don't go all in at once. Divide it into 3 or 4 purchases, buying gradually by month or quarter. 2. Physical gold is easy to hold and safe, but you need to choose a reputable brand like SJC or P&J. 3. Online gold or gold certificates are flexible and easy to trade. However, carefully check the reputation of the platform. 4. Don't keep it all at home. Consider keeping a portion at a bank to reduce risk. Common mistakes when investing in gold. Buying based on news, rushing in when prices rise, and panic selling when prices fall. Putting all your capital into gold and expecting to get rich quickly. Not factoring in the buy-sell spread. The rich often don't talk much about gold, but they always keep a portion of gold in their safe. That's a quiet secret. When everything falls apart, gold is the last thing they rely on. Remember, gold is not for you to double or triple your assets in the short term. Gold is for you to sleep well during unstable periods. It's the anchor that keeps your financial boat from being swept away by the storm. So, we now have 4 types of assets: money market funds, a safety cushion; bonds, a source of stability and discipline; ETFs, for growth with the economy; and gold, a shield against crises. But that's still not enough. To truly make your portfolio profitable, you need a steady cash flow, annually and quarterly, and that is asset number 3. Blue chip dividend stocks, strong businesses that consistently share profits with shareholders. Blue chip dividend stocks, asset number 3 on the list, are the type of asset that both provides a steady income and helps you go along with large, stable companies. If ETFs give you the growth of the entire market, dividend stocks give you real cash flow that flows into your pocket regularly. Why should you have dividend stocks in your portfolio? Passive income. Businesses that are profitable share their profits with shareholders in the form of cash. They are more stable than growth stocks. Blue chips are typically large companies with a low risk of bankruptcy. They protect against inflation. When prices increase, the business still operates and pays dividends. They have the power of compounding. If you reinvest the dividends, you will create a compound interest effect. Criteria for choosing blue chip dividend stocks. 1. A company with a history of paying consistent dividends for 5 to 10 years. 2. A low debt-to-equity ratio and stable cash flow. 3. They are in essential industries, large banks, electricity, water, telecommunications, and consumer goods. 4. They have a sustainable dividend payout ratio of 30% of profit. For example, if a company pays a 10% dividend for the year, it means that for every $10,000 you invest, you receive $1,000 in cash each year, not including the potential for the stock price to increase. The benefit of holding for the long term. You don't just enjoy dividends, you also benefit from the stock price appreciation. Many Vietnamese blue chips have increased in price many times over after 5 to 10 years while still consistently paying dividends. This is the cash cow in your portfolio, giving you milk every day while growing over time. Common mistakes with dividend stocks. Only looking at the high dividend rate without checking the health of the business. Buying penny stocks that promise dividends but are actually unsustainable. Not holding for the long term and selling when the market fluctuates. The wealthy understand that a steady cash flow is what creates safety and freedom. Dividend stocks help you have an additional source of income while your principal still generates a return. It is the bridge between safety and growth. So, now you have a money market fund for liquidity, bonds for stability, ETFs for growth, gold for defense, and dividend stocks for a steady cash flow. But the story doesn't stop there. To truly break through, you need to create a secondary income, a source of income from your own abilities that is not entirely dependent on the market. And that is asset number 2, a side income. A side income is asset number 2. This is a special type of asset because it's not in a safe, not listed on an exchange, and no one can steal it from you. It comes from your own skills, time, and creativity. The wealthy always consider a side income as an asset, while the average person ignores it, so they remain dependent on their salary. Why is a side income an asset? It creates a new cash flow. You can't get rich if you only rely on one source of income. It reduces risk. If your main job has a problem, your side income can still support you. It has the ability to be scalable. Some side incomes can become a long-term passive income. Investing in yourself. The skills you learn to create a side income will stay with you for a lifetime. Side income ideas that are easy to start with a small amount of capital. 1. Digital products. Write an ebook, create an Excel template, or sell a mini course. 2. Online services. Write content, design, translate, or freelance. 3. A small business. Sell things online, dropship, or sell crafts. 4. Rentals. Rent out household items, equipment, or your car. 5. A content channel. YouTube, TikTok, or a blog. It takes time in the beginning, but it can become a passive income source. The 30-day formula to try side income. Week 1. Identify the skills you have or a product you can create. Week 2. Create a prototype, a file, a product, or a video. Week 3. Put it on the market. Post it for sale, upload a video, or take on a small job. Week 4. Measure, adjust, and decide whether to continue or scale it up. A real-life example. A young person with Excel skills created 3 personal finance management files and sold them on social media for 49,000 Vietnamese dongs. In the first month, 100 people bought them, generating nearly 5 million Vietnamese dongs in revenue from just one digital product, and that product can be sold many times without any additional effort. Or a stay-at-home mom who started a meal prep service for office workers, taking on only 10 to 15 orders, earning an extra 7 to 10 million Vietnamese dongs a month. That's also a side income. Common mistakes when creating a side income. Thinking you have to do something big to call it a side income. Giving up when you don't see immediate results. Not valuing your own skills when skills are your most valuable asset. The wealthy always have at least 2 to 3 sources of income. They understand that a tree cannot stand firm with only one root. A side income is those small roots that help your financial tree stand much more firmly. By now, you have 6 types of assets. 1. A money market fund. 2. Bonds. 3. An ETF. 4. Gold. 5. Dividend stocks. And 6. A side income. There's one final missing piece, an asset that most people undervalue, but it is the foundation for everything. Without it, everything could collapse after just one incident, and that is asset number 1, an emergency fund. An emergency fund is asset number 1 and the most important piece of the puzzle that most people undervalue. The rich always have this fund, while the average person doesn't. And this difference is what allows the rich to stand firm when an incident occurs, while the average person collapses. What is an emergency fund? It is money you set aside to be used only in case of an emergency, job loss, illness, accident, or economic crisis. This is not money to invest, it's not money to spend, but it is life-saving money. Why is an emergency fund so important? It provides peace of mind. You will be more confident knowing you have a financial safety net. It prevents debt. Without an emergency fund, you are forced to take out quick loans, pawn your belongings, or sell off your assets when you face a crisis. It keeps your long-term plan on track. Thanks to this fund, you don't have to withdraw from your ETF, gold, or bonds when the market is bad. A person with an emergency fund will get through a storm calmly. On the contrary, a person who doesn't have one will be forced to sell their assets for a cheap price at the worst possible time. How much should you keep in an emergency fund? If you are single with a stable income, 3 to 6 months of living expenses. If you have a family with young children, 6 to 12 months of living expenses. If you are a business owner with an unstable income, at least 12 months of living expenses. For example, if you spend $1,000 per month, your emergency fund needs to be between $3,000 and $12,000, depending on your situation. Where should you keep your emergency fund? A money market fund or a high liquidity checking account is easy to withdraw from and safe. Keep a portion in cash for situations where you need it immediately. Absolutely do not invest this money in risky ventures. Many people make the mistake of day trading with their emergency fund and lose everything. A real-life example. During the COVID-19 pandemic, millions of people lost their jobs. Those with a 6-month emergency fund were able to stay afloat, pay their rent, take care of their families, and keep their investment plans on track. Those who didn't had to take on debt and sell off their stocks, and it took them many years to recover. Mistakes when building an emergency fund. Thinking you don't need it, that bad things won't happen to you. Putting all your money into investments in hopes of getting rich quickly. Not keeping it separate and accidentally spending it when you need money. The wealthy always say, I can miss an opportunity, but I won't let myself be unsafe. An emergency fund is the foundation for all financial plans. It doesn't help you earn money, but it will protect you from bankruptcy. So, we have gone through all 7 assets you need to buy right before. 1. A money market fund, a flexible cushion. 2. Bonds, for stability. 3. An ETF, to grow with the market. 4. Gold, a shield against crises. 5. Dividend stocks, for a steady cash flow. 6. A side income, an asset from your skills. 7. An emergency fund, a solid foundation. If you are fully prepared with these 7 assets, you will enter with a proactive mindset instead of being swept away by the waves. If you miss out, you will lose a decade. But if you start today, you can completely change. We have just gone through all 7 types of assets you need to have before. Each type of asset plays a different role. A money market fund gives you flexibility. Bonds provide stability. An ETF helps you grow with the economy. Gold protects you from a crisis. Dividend stocks bring a steady cash flow. A side income opens up additional resources, and an emergency fund is the foundation that keeps you from falling when an incident occurs. This big picture is not just theory, it's a life strategy. If you want to enter the cycle from a proactive position, imagine a person with all 7 of these assets. They will be like a warrior with a full set of armor, weapons, and provisions. Meanwhile, a person who is not prepared will enter the battle empty-handed. If you miss out, you won't just miss the opportunity to multiply your assets, but you will also have to spend another 5 to 10 years to catch up. That is valuable time you cannot get back. But if you start today, you will turn every month and every year into a step closer to financial freedom. Don't think that you need a lot of money to start. Just $500, $1,000, or $5,000. The important thing is that you start allocating. Every dollar you put into the right asset is a brick that builds the foundation for your future. And remember, no one else but you is responsible for your wealth. Not the government, not the company you work for, but you. The wealthy are always one step ahead. They don't wait, they act. So right after this video, do these 3 simple things. 1. Build an emergency fund right away. Even if it's just the first $100 or $200, you already have a foundation. 2. Open a safe investment channel, a money market fund or an ETF, so your money starts to flow. 3. Invest in yourself. Learn a new skill, and find a way to create a side income. Those 3 things are assets that no one can take away from you. I have prepared a 30-day checklist allocation file for you. You can download it for free in the pinned comments. This file will help you act now, not just listen to theory. Comment below, "I am ready," if you commit to yourself to start this wealth-building journey today. That comment is not just a line of text, it's a promise to yourself. And don't forget, this is just the beginning. Every Sunday at 8 p.m., I will release more videos that go into depth on each asset and specific strategy. If you want to follow this journey, subscribe to the Get Rich Academy channel and turn on notifications. The journey to getting rich is not a giant leap but thousands of small steps. And today, by watching this far, you have taken a very important step. Will come very quickly. The question is, will you enter it empty-handed or with a solid portfolio of 7 assets? The decision is in your hands. And I believe that if you act today, you will not only protect your money but also open up a new decade of prosperity.